Let me show you something that should make every American who has money sitting in a savings account genuinely uncomfortable. The national average interest rate on a standard savings account in 2026 is approximately 0.46%, which means if you have $10,000 saved, money you worked hard for, money you were disciplined enough to set aside, the bank is paying you back $46 a year to hold it. $46 for an entire year. Meanwhile, the S&P 500 has returned an average of roughly 10% per year over the last 50 years. That same $10,000 invested instead of saved would have earned you $1,000 in year one alone. Now here's the part nobody tells you. The bank isn't confused. The bank isn't making a mistake. The bank is taking your money, investing it, earning significantly more than 0.46% on it, and paying you just enough to keep you from asking questions. This video is the questions, and by the end of it, you're going to know exactly how to stop being the person whose money sits still and start being the person whose money works. So in this video, I'm going to walk you through the exact step-by-step path from saver to investor. Clear, straightforward, no jargon, so you can make your money actually work as hard as you do. I'm Chris. Let's get into it. Let's start with something that sounds basic, but that most people have genuinely never been taught clearly. Saving money and investing money are not the same thing. They look similar from the outside. You're moving money somewhere other than your wallet, but they do completely different jobs. Think of it this way. Saving protects your money. Investing grows your money, and those are two different goals that require two different tools. When your money is in a savings account, it is safe, it is stable, the number doesn't drop. You can pull it out anytime you need it. That's exactly what a savings account is designed to do. Protect what you have. It is not designed to make you wealthy. It never was. When your money is invested in stocks, in index funds, in the market, it has one job: grow. And it does that job exceptionally well over long periods of time. The trade-off is that the number moves. It goes up and down. That movement is not a bug in the system. It is the system. It's the price you pay for real growth. Now let's look at what that difference actually means in dollars, because the numbers are the part that most people never actually sit down and look at. Let's take that $12,000 and run it through two different scenarios over 20 years. Same money, same person, same starting point. Only one thing changes: where the money goes. Savings account. $12,000 at 0.5% interest for 20 years equals approximately $13,260. Index fund. $12,000 at 10% average annual return for 20 years equals over $80,000. Same $12,000, same 20 years. One path ends at $13,000, you barely kept up with inflation. The other ends at over $80,000, and that number is still accelerating when you pull it out. That gap, roughly $67,000, didn't come from earning more money. It didn't come from cutting lattes or driving a cheaper car. It came entirely from where the money lived for 2 decades. That's the real wealth gap in America. It's not always between people who earn different amounts. It's between people who save and people who invest. And here's the compounding reality that makes this even more important to understand. In year one, the difference between those two paths is maybe $1,140, not dramatic. By year 10, the gap is around $19,000. By year 20, it's $67,000. By year 30, that same $12,000 in an index fund is sitting at over $200,000. The curve keeps bending upward, and every year you wait, you're giving up a slice of that curve you can never reclaim. Year 1 gap, roughly $1,140 difference, easy to ignore. Year 10 gap, roughly $19,000 difference, hard to ignore. Year 20 gap, roughly $67,000 difference, impossible to ignore. So if the math is this obvious, and it is, why do so many Americans spend their entire working lives in savings accounts and never make the move to investing? It's not because they're bad with money, it's not because they don't care, it's because of how investing feels compared to saving. And feelings, when it comes to money, almost always beat logic. When your money is in savings, every time you open the app, it's the same number, maybe a tiny bit higher, never lower. That consistency feels like control, feels like safety. Investing doesn't feel like that. Your portfolio might be up 4% on Wednesday and down 3% on Friday, and nothing actually happened. No company failed, no economy collapsed. The market just moved, the way it always moves. But that drop on Friday feels like losing money. It feels like a mistake. And that feeling pushes people back to the savings account where the number never drops. The second reason people stay stuck is complexity. Most Americans believe investing requires special knowledge, or a financial advisor, or a minimum of thousands of dollars, or a careful study of the markets before you touch it. It requires none of those things. The most effective investment strategy for most Americans is genuinely simple, and we're going to walk through it right now. But first, let me be clear about something. The goal is not to stop saving. The goal is to save smarter and invest alongside it. These are not competing activities. They are two tools doing two different jobs at the same time. Let me show you the step-by-step path. Here is the exact sequence, not theory, the actual order of operations that makes this transition work without putting your financial security at risk. Step 1. Build a real emergency fund first. Before a single dollar goes into the market, you need 3 to 6 months of actual living expenses saved in cash. In a savings account, you do not touch for anything except a genuine emergency. Not an opportunity, not a sale, an emergency. Here's why the step comes first. The single most common reason people sell their investments at exactly the wrong time, usually during a market dip, locking in losses, is because something unexpected happened in their life and they needed cash fast. Medical bill, job loss, car breakdown, and because they had no emergency fund, they had to sell their investments to cover it, right when the market was down. Your emergency fund doesn't just protect your lifestyle, it protects your portfolio from your own financial emergencies. Without it, investing becomes unstable. With it, investing becomes untouchable. Step 2. Separate your money into 2 buckets mentally. This sounds simple, but it is genuinely one of the most powerful mindset shifts in personal finance. From this point forward, you have 2 categories of money, not one. Bucket 1 is your safety money. This is your emergency fund and any short-term savings you'll need within the next 1 to 3 years. It lives in a high-yield savings account. It doesn't fluctuate, it's not for investing, it's purely protection. Bucket 2 is your growth money. This is everything you invest. It is allowed to move. It will go up and it will go down. That's its job. You don't panic when it dips because you know your safety money is in bucket 1, untouched and stable. The moment you separate these 2 buckets in your mind, the emotional anxiety of investing drops dramatically. The market can fall 15% and you sleep fine because you know your stability money isn't in the market. Step 3. Start investing small. Here's the mistake that stops most beginners before they ever start. They think they need a large amount to begin. They don't. In 2026, most major brokerage platforms, Fidelity, Schwab, Vanguard, allow you to open an account and start investing with as little as $1. Fractional shares mean you can buy into almost any fund with whatever you have. You can start with $50 a month. You can start with $25. The amount is almost irrelevant at the beginning. What matters is building the habit. Because a person who invests $50 a month consistently will almost always outperform a person who waits until they have $5,000 and then invests it all at once trying to pick the right moment. Consistency beats timing. Every time, without exception. Step 4. Keep it simple. Start with index funds. This is where beginners make the most expensive mistake. They open a brokerage account, feel the excitement of finally being in the market, and immediately start looking at individual stocks, or crypto, or options, or whatever's trending in their feed that week. Don't. Not yet. Maybe not ever. The simplest investment available to you is also historically one of the best performing, a total stock market index fund. One fund, hundreds with thousands of companies inside it. When you buy it, you own a small piece of the entire American economy. Not one company, not one sector, not one bet. The whole thing. Warren Buffett, the most successful investor in American history, has said publicly and repeatedly that for most individual investors, a low-cost S&P 500 or total market index fund will outperform nearly every other strategy over the long run. When the greatest investor alive tells you the boring option is the best option, that is worth listening to. Look for funds with expense ratios below 0.1%. VTI at Vanguard, FKSAKX at Fidelity, SWTSX at Schwab. Set it up, automate it, leave it alone. Step 5. Stay consistent. Let compounding do the work. This is the step that actually builds wealth, and it requires almost nothing from you except patience. Let me show you what consistent investing actually produces. If you invest $300 a month into the stock market and it averages 8% annual returns, conservative, below the historical average, here's what happens over time. After 25 years, your portfolio value, $285,000. Amount you contributed, $90,000 of your own money. Pure compound growth, $295,000 created without you doing a single additional thing. You put in $90,000, the market gave back $195,000 on top of it. That extra $195,000 didn't come from overtime. It didn't come from a side hustle. It came from time, consistency, and leaving the money alone long enough for compounding to do what compounding does. And here's the part that really matters. Discipline is the strategy, not stock picking, not market timing, not following financial news. The investors who win over 20 and 30-year periods are almost never the smartest ones. They're the ones who kept contributing when headlines were terrifying, who didn't sell when markets dropped, who treated volatility as background noise instead of a signal to act. Let me give you the clearest way I know to think about all of this. Saving money is like keeping grain in a sealed container. It's protected, it's preserved. Nothing gets in, nothing gets out, nothing grows. It'll be there exactly as you left it years from now, maybe slightly less valuable in real terms because inflation quietly chips away at it, but it's there. Investing is like planting that grain in soil. The first few weeks look like nothing happened. The ground is flat. You can't see anything. You might even start wondering if it was a mistake, but underneath the surface, something is growing, slowly at first, then faster, then with a momentum you couldn't have predicted from looking at the soil on day one. The people who plant and walk away, who resist the urge to dig it up every time the weather changes, are the ones who come back years later to something that has completely outgrown whatever they imagined when they put the first seed in. That's the whole game. Plant consistently, walk away, don't dig it up. I know what some of you are thinking right now. Chris, this all sounds great, but what happens when the market drops? What if I start investing and immediately lose 20%? It's the right question, and here's the honest answer. Market downturns are not exceptions. They are built into the system. The S&P 500 has experienced a correction of 10% or more roughly once every 2 years on average. Crashes of 20% or more have happened multiple times in the last 3 decades, 2000, 2008, 2020. Every single time, the market recovered and eventually set new all-time highs. Every single time. But here's the insight that changes how you feel about downturns entirely. For a long-term investor who is still in the accumulation phase, still adding money every month, a market drop is not a disaster. It's a discount. When the market falls 20%, your $300 monthly contribution buys 25% more shares than it did the month before. You are accumulating more ownership at lower prices. The people who got wealthy through consistent investing didn't get lucky. They got comfortable with volatility. They understood that short-term drops are the price of long-term gains, and they decided that price was worth paying. The only way a market crash permanently hurts you is if you sell during it. If you stay in, the crash is temporary. If you sell, the loss is permanent. Keep your emergency fund intact so you never have to sell at the wrong time. That's the whole strategy. Let me bring all of this together cleanly before you close this video. The 5 steps, in order. 1. Build a 3 to 6 month emergency fund in cash before anything else. That fund protects your investments from your own life emergencies. 2. Separate your money into 2 buckets mentally. Safety money in savings, growth money in investments. 2 different jobs, 2 different tools. 3. Start investing with whatever you have right now. $50, $100. The habit matters more than the amount at the beginning. 4. Keep it simple. A low-cost total market index fund is where most Americans should start, and honestly, where most should stay. Simple works. 5. Set it to automatic and leave it alone. Consistency over decades is the actual wealth-building strategy. Everything else is noise. Here is what I want you to take from this video more than anything else. Saving money gives you security. Investing gives you freedom, and the earlier you build both at the same time with a clear system, not guesswork, the more powerful your financial future becomes. The gap between where you are and where you want to be financially is almost never about income. It's almost always about what you do with what you already have. If this video helped you see that path more clearly, hit subscribe. New video every single week on this channel, and every one is built around one goal: giving you real frameworks you can act on, not motivation you forget by Thursday. And drop a comment right now. Are you currently in the saving stage, the investing stage, or somewhere in between trying to figure out the next move? I read every comment, and I want to know where you are.